You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Joe Venazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. And now, get ready to hit the Option Block.
All right, everybody, that music means it is time to rock out once again with the Option Block. Everyone's favorite. Hope it's your favorite. It's certainly my favorite bi-weekly source for all things options related. My name is Mark Longo, coming at you live for this show at least every Monday and Thursday, noon Central, 1 p.m. Eastern. Or, of course, get it on your podcast player of choice. We don't judge as long as you hit us up. Questions, comments, insights, pearls of wisdom, and indeed vote in our polls. We do like to hear from you guys. I'm mixing it up a little bit on the old all-star panel. Let's start with our usual cohorts, my partners in crime. Let's start all the way out in that sleepy hamlet known as St. Charles, where we are joined by Uncle Mike Tosaw from the appropriately named St. Charles Wealth Management. Uncle Mike, welcome back to the show, sir.
Good to be here as per usual.
As per usual, indeed. And also joining us from, who knows, parts unknown, maybe the offices of Carmen Line Capital, maybe the headquarters of Option Pit, maybe from a Costco near you. We don't know. He is the Greasy Meatball, Mr. Mark Sebastian from OptionPit.com by way of Carmen Line. Mr. Meatball, welcome to the program. Where are you joining us from today?
Well, clearly Costco, because the stock has been on such a rip since it had earnings last week. But in all seriousness, I'm at our world headquarters, located over the heart of the financial center in downtown Chicago, overlooking beautiful LaSalle Street with the little itty-bitty corner of the lake I can see.
The little, that counts
I have a lake view here.
That counts as a lake view. There you go. There you go. That's 3x the price
kind of
now.
A big deal.
Congratulations for you. 3x the rate for that little sliver of lake. I hope it's worth it, sir. You can get a giant warehouse somewhere or a sliver of lake. You have chosen the latter, obviously. Well done.
Yes, indeed.
All right. And also joining us, mixing up the old all-star panel, going to be maybe mixing things up a little bit going forward, which is kind of fun. Bringing in a new co-host seat, and occupied today is going to be the Fidelity co-host seat going forward. We're going to rotate a bunch of fun people on from throughout the different aspects of Fidelity's options offerings. And joining us to kick things off, we have Trey Jarrell. He's joining us from Fidelity's Trading Strategy Desk. Trey, welcome to the Option Block.
Yeah, thanks for having me. Very excited to join everyone here. Looking forward to a great show.
Trey's joining us now by the magic of telephone. We're going to work out a better connection for him going forward. So if he's a little muffled, that's why, listeners. But Trey, since this is your first time on the network and indeed on the program, why don't you go ahead, give our audience a little bit of an overview of your background in the options market, as well as what it is you do over there at Fidelity.
Yeah, absolutely. Appreciate it. Well, I do want to start out. I don't want to make anyone jealous. I'm calling from sunny Jacksonville, Florida, here today. So at the Fidelity office down here.
You win the location fight today. Because I'll be down in Fort Lauderdale and Boca in about 10 hours. So I'll be joining you soon.
Great. Bring some cool weather down. Actually, we're warming up a little bit. We could use it. But a little bit about my background here. I actually started at Fidelity back in 2006, so I've been with Fidelity for a long time, going on year 13, surprisingly. Worked a couple of different jobs here within Fidelity, but about 5 years ago in 2014, a small group of representatives here started a pilot team known as the Strategy Desk. And really, the idea behind it was we wanted an opportunity to get into some more detailed conversations with Fidelity's traders. We've got a great trading base here, but they didn't necessarily have someone they could talk to get in depth about their different trading strategies. So the team was formed, and we've been doing that ever since. We worked quite a bit with options, obviously joining you here today to discuss that. We also help clients with understanding charts and using technical analysis. We do a number of different educational activities here at Fidelity, host webinars. We do great small group classroom sessions on these same topics. And, really the main thing, a lot of our job is spent just working with clients one-on-one, having those conversations with them.
A technician, a chartist. You have to be our resident go-to guy for all the technical questions we get over here, because most of us not really big chartists. I mean, you can add a little bit of that flavor to the show, which will be fun. And speaking of the show, let's get rolling. It's time to dive on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, everybody, welcome to the trading block, the portion of the show where we break down, surprise, surprise, what the heck is trading out there. And in today's market, it's, we're in kind of that schizophrenic mode these days where, this is the end of times, it's the end of times, it's the best of times. Last week, it was the end of times. Pretty much all week, it was a very consistent sell-off week, taking a little bit of profits off the table there. So one of our first real net down weeks, I think, since January. So it was quite a little bit more consistency. This week we're back. The worm is turning again. How much that worm is turning depends pretty much on where your investments live in the market. If you're kind of old world economy, let's say, like the Dow, then you're only up about 1/3 of a percentage point. If you're kind of large cap, like most of you are playing in the S&P, then you're up about a little more than a percent, about 1.1% out there. And if you're super tech heavy in the NASDAQ land, you got a big smile on your face. You're up not quite 2%, but about 1.75%. So big up day for the NASDAQ out there as they're getting back some of the ground that they lost over the past week. Of course, our old friend, the VIX cash, all this green on the screen means red on the VIX cash screen, off over a handle, nearly a handle and a half, right around 1460 or so, which is down quite a bit, down about 1.7 or so handles from where it was just our last episode. So obviously, vol coming in quite a bit. We were kind of weighing on that on the Vol View show on Friday. We all kind of thought it was going to come in. A question of how much, we shall see by the end of the week, which of us is correct. But Trey, this is your first time joining us here on the old All-Star panel, so I will give you pride of place, sir. What is lighting up your tape over there at Fidelity today?
Yeah, well, I guess we'll start with a little of the chart flavor. So you mentioned the S&P. A couple of things we were looking at from technical levels, just going back to our old staple of the simple moving averages. It was an interesting 200-day coming into play. I thought it looked like it might be a little bit more pronounced here this morning, but it looks like the S&P was really looking to blow above it. I think the level was around 2770 or 2750 at the 200-day. But really shot up from there and actually crossed this above the 20-day here recently at the 2771 thereabouts. So, fairly positive from a technical standpoint. I thought that 200-day might have a little more resistance, but didn't look at it here from this point. So one of the other things I took a look at today, too, I've got a neat screen here. Fidelity allows us to see orders by Fidelity customers. Just give us some idea of what everyone's different underlines that our customers are trading here today. Had a couple of the usual suspects on here. Apple had a decent start, nice upgrade over the weekend from buy to neutral. Tesla popping up on the scan as well. But really the one that was, by far the most traded so far today, and no surprise, was Boeing. Right, so pretty horrific news here over the weekend, and some interesting action on the price here today. So, looking at the chart itself, big gap down. Actually, looked like it filled that January gap, which I thought was kind of interesting, crossing through the 50-day, but starting to bounce back here pretty strong throughout the day. Looking at the options market, thought the spike in volatility was, fairly interesting here as well. The stock, popped up to about, I think, a 38, 39 implied volatility here today. It's coming down a little bit, showing right now around 34. So not to be surprised. We see this type of, price move, seeing the volatility spike in there certainly makes sense. Jumped back to, the last, serious crash in Boeing, the plane crash here on October 29th. Get an idea what happened with vol, and kind of a similar scenario, right? Had a implied volatility spike up to about 39, but a few days after that started to come back down. So this is one I think will be on the radar here. Price certainly been an interesting component, but this vol began to come back down with this here as well. The other thing I thought interesting, just looking at the option statistics, I almost had a feeling with this type of sell-off would be seeing maybe a little bit more heavy activity on the put side of things, perhaps hedging or a little more concern there. But looking over the trades of the day, pretty evenly matched. Was surprised to see. It looks like a lot of people maybe taking advantage of that high implied volatility. Had a few more call and put sellers actually out there than buyers. So that kind of caught my eye here as well. But that was, I think, the main driver here today that we're taking a look at, and as well as Fidelity customers.
Yeah, Boeing sounds like Fidelity customers are lining up with the broad market there. Boeing, as you mentioned, taking it on the chin today. Another crash after a recent crash as well. So that's never good news for a manufacturer. Our neighbors here, right across the street, actually, Boeing, right across the street from the Options Insider studio. I checked before showtime. I didn't see any scrambling or scurrying going around out there. So.
That Supermax stuff is that's concerning though. That this is their brand new plane and it's now got two crashes. I mean the safety record of the 737 is really good, and yet here we are, this brand new plane that's supposed to be the most high tech ever that they've made is the one that keeps kind of falling out of the sky. So I'm a little concerned. One thing to recognize, Boeing had been completely overbought leading into this kind of 6-day sell-off. I mean, the move it made out of earnings, running up another 70 handles, its earnings jump was about 100 points. So it giving away some of this maybe makes some sense. Sometimes news and technicals can kind of line up. People are like, oh, the technicals were telling it. Or you'll just see kind of, some sort of news that allows a underlying to switch directions, sends the stock into like along the lines of technicals, because that's kind of the way people set up. But this is, if you're wondering why the Dow isn't up, Boeing at one point was counting for like 350 points down in the Dow, and so there is just. It's a little less than that now, but the fact that the Dow is up 0.5% with Boeing down what it's down just shows you how strong the balance of the market is. This is just a phenomenal sell-off in Boeing mixed with a phenomenal, one might say, face-ripping rally in the S&P 500.
Yes, it has been looking right now, Boeing off about 28 handles, but that at about 394.5, but that's kind of bouncing off the lows. It came into 371 off about 23 more handles to start the day here. So it's kind of, even though it's off on the day, it's kind of been mitigating some of those concerns. And you're right, Mark, it is concerning that it is the newest model, the kind of the future of the company there that is perhaps has some question marks about it. Not a good thing. So I think we'll wait and see. But clearly the market very concerned, but maybe not as concerned as it was, I should say, when it started the day. Uncle Mike, in addition to Boeing and all the other madness, what's catching your eye out there today, sir?
Well, a couple things. I think that just from a technical standpoint, I think when we were talking on Thursday, I think I made the very bold prediction of being somewhat bullish, maybe kind of. I think were my words or something along those lines. And so I actually did end up adding some deltas to our positions at the end of the day on Thursday. And so obviously Friday morning, I'm kicking myself. But then by the end of Friday, one thing that I really did like about Friday's action in the marketplace is that we did come down. We came down off of what appeared to be a poor employment report or unemployment report, whatever way you want to look at it. And a lot of people were saying that the numbers may be revised because they didn't feel that was a good number, whatever the case may be. But ultimately what happened on Friday is that when the market dipped, we rallied. And typically that has been, from my experience, a pretty bullish sign for the near term. It has been, of course, today with what's going on with the market. The fact that Boeing is just falling out of the sky, no pun intended. Okay, pun intended. I couldn't resist that one. Boeing is just not doing so well today, and we're still having the market rally with which we are. And this is a pretty strong rally today, considering what's going on with Boeing. I mean, we just crossed the 278 mark on SPY. We just made a new high right before it was my turn to talk on SPY. So there's a lot of positive things going on. Two things, though, that it's broken record.
We literally were below the. I mean, Mike, we were below in the SPX and the SPY. We were below the 200-day moving average for one stinking day, and that is it.
Yeah.
I mean, that basically it was a trampoline.
It really was. And so the one thing it's broken record time now, of course. We have the 2,800 mark coming on the SPX or 280 and SPY, whatever way you want to look at it. We have had a hard time going above that and staying above that. We did for a while last fall, but from a technical standpoint, not to steal your thunder, Trey, but just from me not being much of a technician, but we have had a hard time continuing to stay above that 2,800 mark. And then, of course, we have the looming China deal that may or may not happen this century, it seems. We still have that to contend with at this point. But from when we did have a very nice bounce today from the lows, actually when the lows were put in on Friday, intraday, to where we were able to have the strong finishes that we had had. If you look at the overnight action, that was happening in the marketplace with the futures coming into today, we did drop a little bit, and that could have been from what was going on. But we do have a very strong rally today, even with Boeing doing what it's doing. So this might be the momentum that we will need to break through that 2,800 mark that has been so difficult to break through and stay through for quite a while now.
Mike's always going on about this 2,800 level. You have a lot of people calling your desk, Trey, looking for technical levels. Is that a level a lot of them are fixated on as well, or is that just a level Mike has concocted in his fever dreams here?
I think he's got a good point, right? So looking back at the chart, obviously we know, October, November, failed at that 2,800 level, and not just a simple fail, right? Those were pretty sharp sell-offs. Ultimately had a lot of trouble back there in July 2018 breaking. So. I think that looks to be a fairly important level. I'd agree with Mike on that one.
Let's see if the market agrees with what you're saying, too, about Fidelity, or not Fidelity, about Bank of America and Bank of America. I'm getting ahead of myself looking at the list here. But no, about Boeing, of course, and it's lighting it up. At Fidelity, let's see if it's dominating the tape here as well. Spoiler alert, it's doing pretty good. Let's start at the top 10 most active equity options. Number 10, Micron, about 122,000. Number 9, AMD, with 154,000. Number 8, Facebook, $1.69. Number 7, NVIDIA, 178,000. Number 6, ELAN. Good old ELAN. ELAN, 179,000. Number 6, or excuse me, there's a 5. What is it? 2, 4, 5. No numbers on his list, listeners. Number 5, NEO here. Our old friend NEO continues to be in that top 10, 190,000. Number 4, GE. Another one that persists in the top 10, 191,000. Then we get to 3, Boeing, 288,000. Interesting, looking at the paper here, you think given what's been going on today, it would be dominated by put paper. That is not the case, kind of what Trey alluded to earlier. It's pretty much even paper, 52% to the calls, 48%. Probably a lot of that speaking to the bit of a rally we've seen as midway through the session here, maybe some call paper flooding in, but surprisingly equidistant paper out there on both sides of the option chain, given the fact that the underlying for a lot of the day was very one-sided. Number 2, Apple, much more one-sided paper out there, 404,000 contracts for Apple, 69, almost 70% of that coming on the call side of the tape. And number 1, Lilly, yet again, 858,000 contracts. Exactly even, 50% to the calls and 50% to the puts. Really quickly, we'll do the indices too. VIX, about 305,000 contracts coming into showtime. ADV, a little bit north of 500,000. SPY, 1.5 million contracts on the tape today. ADV, about 2.5 million. SPX, 674,000 contracts. ADV, a little bit north of 1, about 1.2 million. The Qs, where a lot of the action is today, 492,000. Still not hitting that ADV, but threatening it. 641,000 is the ADV out there. And let's go out to Russell, to IWM, 187,000. On the tape today, 350,000 is the ADV. All right, let's keep on rolling. Let's get on into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
Everybody, you know the drill. It's time to get funky. It's time to get weird with the old odd block. Let's kick things off. Mark, we're going to play a little bit different game today. We're going to look back a little bit at some of the names we profiled recently on the show and see how things worked out. We got a bit of a theme to today's odd block. It's going to be harvesting the old risk premium, this time to the upside. No put. I don't see any puts on this list. So harvesting some covered call premium probably. Let's see how it worked out. Let's kick it off with everyone's favorite ticker. I know one you check every day when you wake up, Mark, as do I, as does everyone out there, of course. It's QuinStreet, of course, ticker symbol QNST. Trading today about $13 even, up about 22 cents, nearly 2%, so a good day for QuinStreet. We actually profiled them back on the show on February 7th, so a little over a month ago now. At the time, it looked like someone was harvesting the old risk premium to the tune of the Feb 20 calls, blasting them out for 32.5 cents, 3,000 times. And looking back at the stock here, it seems like this one, you can look at what the level is right now, and you can probably make an educated guess on how well this one worked out. It actually worked out pretty well, at least from the option side. This guy had some underlying, obviously, too. Maybe he's not laughing all the way to the bank, but all we know is the option side. And the stock dropped from 19 to about 13 within a few days of this trade going up. So not bad timing, at least on the options side. And then, of course, these calls went out worthless on the day of expiration. These things were still open. Go figure. Why would he close them out? They were 6+ handles out of the money at that point, so well out of the money. It looks like this guy pocketed a nice, cool, about $100,000 or so for his efforts. Yeah, going out on expiration, this was the number 2 open position, the Feb 20s, with about 4,500 contracts out there. So, Mr. Meatball, kicking things off. Looks like our first one worked out pretty well, taking a nice $100K for about a month's worth of work. What do you think?
Yeah, assuming, although it probably was, if you look at the chart of this thing, the chart isn't exactly great against his call premium. So if these were covered calls, then the call part worked, the covered portion did not. This stock, since since they announced earnings in February, has fallen from a high of 20.02 to currently trading $13. So, if you assume there's an underlying attached to it, which undoubtedly there is, then QuinStreet Inc. Not the best covered call.
No.
that has ever been covered.
Yeah, this kind of puts the lie to the covered portion of that. People always, I got this cushion with my covered call. This guy only got 32 cents. The stock dropped $6. So that's not gonna,
that's not gonna
make a dent in your $6.
No.
So yeah, on the I was being charitable with this guy. On the option side, looks good, but that 100K against 6 points in the underlying, not gonna probably look pretty good on the old balance sheet. But we're keeping an optimistic outlook here. Let's see. Well, maybe he was just naked selling call, which we advocate heartily here on the show. I'm joking, we do not. So interesting stuff. Let's see if we can keep it growing. More premium harvesting. This time in what do we got here? All tickers that you just, you quote every day before you go to bed and when you wake up in the morning. This time it's Plains GP Holdings. Ticker symbol PAGP, PAGP, trading today $24.15. Pretty much kind of unched from where this trade went up back on the 4th. This is from the 4th of February, and on that day the stock closed $23.20. So it's about $1 north of where it was, but it's kind of been vacillating around. Hit a high of looks like 24.5 was the high over that period, at least until expiration. But over that period, let's break down the paper first before we get any further into the spoilers. What we saw on that day back on the 4th was about 12,000 of the Feb 24 calls. Someone coming in again, blasting out the bid about 12,000 times for 26 cents. So a penny off the bid. I am mistaken. They were 25 cents at 40. He blasted them out 12,000 times for 26 cents. This was all opening. And pretty much after that trade went up, the stock did a whole bunch of nothing. Looking at, like I said, right now it's about 24.15. It got up to as high about 24.5, but not enough time, I think, to really have these come back to bite them. Let's see exactly on the 15th. Well, it was 24.25, so it was a little dicey here. That's where it went out on the expiration. So they kind of went out pretty much. They went out open still, so he kept them open. But it was pretty dicey. He didn't close them out going in any further. There's about 14,000 total open by the time expiration came out. It was, again, the number 2 size open interest position out here. So on paper, you might think, well, these bad boys went out kind of in the money. So interesting stuff. They're not quite the worth. If they went out worthless, this guy would have pocketed about $300,000. As it worked out, the stock pretty much closed. They were pretty much right where they were, about a couple of cents difference. So he didn't take them off during the day, which is kind of interesting. I'm looking at the life-to-date flow here, courtesy of our friends over there at Trade Alert. We did see a lot of volume on the 14th, the day before expiration, about 18,500 traded, but the OI was pretty much unched, stayed around 14,000. So it's like a lot of back and forth flow was going on those days. So interesting stuff. Another one, Mr. Meatball, that on the surface looked like it might have worked out, but then you dig in a little bit, and it doesn't seem like this guy, the stock went out pretty much exactly where his calls were. So maybe not as bad as the other one. I think he'll take this one over the other one, obviously. But still, maybe 0 for 2 here net on the positions. What do you think?
It certainly looks like that could have been the case. He did not get the big win he was looking for. This one does get some big trades, though, every now and again. There was the day before expiration on February 14th, the Feb 24 calls, 18,000 of these traded then for 15 cents. So this is one where it'll get some spastic volume. I'm looking here, and they'll do 12,000. I actually think he closed on February 14th and did pretty well. I think he made I think he made 15 cents.
He might. There's a ton of paper out there. It's weird because the OI wasn't that much changed the next day. So
it's weird. It definitely reduced by. The next day it dropped. They did 18,000 of these, and the next day the OI dropped by 9,000. So I don't know. That's weird.
Yeah, the OI on the 4th was about 14,000. The OI after these big trades on the 14th, about 14,000. So it was a whole lot of bunch churning and burning over that 10-day period.
It's a weird one.
Yeah, the 4th was obviously the trade we profiled. So yeah, this kind of what makes this segment fun. is
More
all sorts of.
Yeah.
All sorts of weird ones. This guy could have pocketed 15 cents. I don't think he was deft enough to take the full 26, in which case he would have taken about 300 home. I don't think that's the case. Half of it would have been better than nothing. And yeah, he had that's the danger of being, we say this before, listeners, being short premium going into expiration like that. It's total, and this literally was a crapshoot. Where he closed these out was pretty much going to impact how this looked, because these were pretty much one delta going into the end there, which is always fun. No sweating, no popping tums at all involved when you're hovering right around the strike. A little bit of fun over there. Let's see if we had some fun for our final one. Also harvesting some call premium, also from February 4th. This one is Canadian Pacific Railway, this ticker symbol CP. Trading today 206.5, up about $1.50, or about 0.75%. Let's see, when we profiled it back on the 4th, this thing was trading, where was it trading? It was trading 204.22. So we're up about $2 and change, about 2.25 since then. What did we profile back then? Some more call writing, looks like, to the tune of the March 210. So a little bit different, a little bit meatier calls this time around. These were trading with some juice. And these were below the bid. They went up 3,355 times for $2.91. They were $3 at 340 when the trade went up. This was also opening, and they looked pretty good for a while there. The stock sold off pretty quickly down to about 197.5, and then it rallied pretty much back up to unched right around expiration time there. So he had a little dip, had an opportunity to take those bad boys off during that dip, and did not do so. These things actually were still open on the 15th. There was about 4,000 open after the trade went up on the 4th, and there was about 4,600 open on the 15th. There were no sizable trades in that period, an opportunity maybe to take these bad boys off. But still, didn't matter, because they were the 210 strike, and the stock was right around 204 on expiration. So the 210 going out worthless. Looks like, again, this one now, if you're looking at the covered call side, obviously the covered side was actually unched. He had a little bit of a scare there, but it wasn't too bad. So it looks like he kept his premium. This one, Mr. Meatball, because these options were kind of meaty. These were $3 options. He actually did all right. He looks like he took home about $1 million for his work. What do you think of this one? Maybe a little bit better than the others? Stock unched, $1 million in options premium. There are worse things to do for a month. So I'm going to go out on a limb and say, yes, you are correct, Mark. There are worse things to do for a month out there. All right. Meanwhile, though, let's keep on rolling into our next segment. It is time to go into the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the strategy block.
All right, everybody, welcome to the Strategy Block. This is indeed the portion of the program where we break down the world of strategy, at least according to usually Uncle Mike. Trey, one of these days, I won't make you do it on your first show, because that would be markedly unfair of me. But one of these days, I'll have to get you and your Fidelity guys, because you're always interacting with the clients over there on the trading desk, getting some of the strategies that they're asking about. We can kind of break them down on the show. So that'll be a little homework for future episodes of the show for you guys over there. But I won't be that guy. I won't make you do it on the first show. Instead, we'll let Uncle Mike run rampant on the episode today. Uncle Mike, we're just talking about a lot of covered calls in the strategy block. So it sounds like this might be a good time to maybe talk about a little covered call strategy. What do you think?
I think today would be a great idea. Your birdies must be out spying on me again. Is that the case, Mark? You got the St. Charles birds working?
I am always spying. I'm like Roz in Monsters, Inc. I'm watching, always watching.
Oh, my goodness. Oh, my goodness. That's crazy. Good to know, though. Good to know. So today we want to go over the covered call, and it's a basic strategy we talked about, of course, in the odd block, as well as we talk about on the show quite a bit, actually. But I want to go through and really emphasize something on a day like today on why it can be important. So let's say that you're a dyed-in-the-wool wheel trader, or you want to use the old wheel strategy where you wheel in, wheel out, but you sell a put to get into the stock. Once you get into the stock, if it gets put to you, you then sell a covered call, and then you get called away, then you sell another put to get into it. And it is the wheel of fun, we've called it on the show many times. But I want to just really emphasize today another thing that I've talked about on the show many times, and on a day like today, why I think it's very important. I think that an important tool to have in your trader toolbox is that of selling a call spread against a stock, along with just selling a covered call. Now, of course, the benefits of the covered call is that if the stock stays the same or goes down, you're obviously better off by having the covered call in your back pocket. You'll get to enjoy the time decay of the premium. You'll get to enjoy the minor, and I want to emphasize the word minor, hedge of the covered call itself in case the stock goes down. You have that in your favor. Now, the disadvantage of the covered call, of course, is what if the stock actually goes up? Now, as a trader, if you're a covered call person, you have to have the mentality of, okay, that's great. That means I made my maximum amount of money. If the stock went up and I got called out, it works for me. I'm happy with that. However, what if you're not happy with that? And what is something you can do as a way of having your cake and eating it too, for lack of a better term? And we've talked about this on the show a lot, and I like selling the call spread against the underlying. One thing over the course of probably the last 2 or 3 years, and I've been doing this for 15 years now, over the course of the last 2 or 3 years, I've really added this as part of something I really like to do, whether it's selling it against a stock or selling it against another call if you're doing stock replacement type of thing, is I like selling a call spread. And here's why. You can still enjoy the benefits of premium, but you have something in place that can protect you against a day like today in case the markets do go significantly higher. So let's say, for example, that normally XYZ stock is trading at $48 a share. And normally you'd want to sell the 50 covered call against it. Now, of course, that's going to work out great if the stock were to stay below the 50 mark. And it would still work out great even if it went above the 50 mark. You'd take no action and you get called away. You made your maximum profit for the course of a week, a month, a year, whatever the case may be. It's still a good thing. However, on a day like today, one thing that is important is that you need to have some type of a plan. So let's say that you were short a covered call going into a day like today, and the market gives as Mark puts it, a face-ripping rally. Then what do? Do you roll your call higher? Do you just let it get called away? But then if you let it get called away and you just sit on it for another 2 weeks, you might be missing some pretty serious market action for that. Well, in the case of the example I just said, instead of just selling the 50 call, perhaps sell the 50 call, own the stock, and then buy perhaps a 52 half call. Now, what that does is that does reduce the premium with which you're going to take in. No doubt about it. However, with volatility the way with which it is right now, the VIX is lower again. I'm not saying low, but it is lower than what it was. Then the cost of the 52 half call probably won't be that much money. And if that's too much, then maybe you might want to sell a 55 call. And so, buy a 55 call and do a 50-55 call spread. I'm not sure. I'm just kind of making this up to give us a textbook example of it. Now, everybody who sells premium, it seems, likes to be a seller, not a buyer. In fact, premium seller, people who are dyed-in-the-wool premium sellers, they often say if you buy out of the money options, you're going to end up out of money. Well, they can serve their purpose. Because let's say that maybe that 52 half call or the 55 call, let's say it just costs a few pennies and you're getting significantly more money for the 50 call that you're selling. Over time, you're probably going to, if the stock stays the same, most of the time, you're probably going to end up losing money doing that. But there could be one time that stock actually goes up to 58 one month because of the fact that they found a cure for whatever disease that they were trying to cure. They had a really stellar earnings announcement, whatever the case may be. And that one time that actually happens, those few pennies that you trade could actually make the difference. Now, with that being said, does that mean that I do that every time? No, not at all. There's certain stocks that I have just straight covered calls on. There's certain stocks that I just own. And there's certain stocks that I will sell a call spread against the stock itself. So what I want to emphasize on here is that this is not the end-all, be-all strategy. it's just a really good tool to have in your toolbox that, quite frankly, I just have gone to it myself over the course of the last 2 to 3 years, and it's been a nice option to have when need be. Of course, like I said, there's other choices. If you can either let the stock get called away, you can roll the call up, you can do a lot of different things with it. But as an additional tool to have in your toolbox, I think this is something that could potentially benefit a lot of our listeners out there and a lot of traders in general. And that is the strategy block for today.
Always
Happy
nice
spring.
Always nice to have options when you're trading options, is it not?
I would totally agree. I remember that, in fact, one of the slides that I used to put up in a previous life was options give you options. I'm sure no other option educator has ever thought of that.
Yes, no one else has ever used that in the history of options. I think you are unique in that sense. Speaking of unique, our audience is certainly unique. Let's see what you guys have on the brain, a little bit of the old mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
All right, everybody, let's kick things off. Paying off our little flash poll from the end of last week. It's actually still open, so if you haven't had a chance to vote, get on over there to @options on the old Twitter machine. It's got a couple of hours left. So if you've listened to the podcast, it'll be too late, probably. We'll see how this goes when it goes out. But if you're listening live, you can get in there and make your voice heard. We asked you at the end of last week, the numbers are finally out for February. And January and February off substantially from 2018's volume numbers. Remember, we asked you guys back at the beginning of this year, 2018, a record year, 5.1 billion options changing hands in the industry over the course of the year. Did you guys think we would beat it? You guys unanimously almost said, yeah, we're going to blow the doors off of it. I was a little skeptical. I think the meatball is a little bit skeptical too. And then fast forward a couple of months, we have 2 months under our belt now. 2 of them both disappointing from an overall volume perspective. So we thought we'd ask you guys again. Do you guys still think we're going to blow the doors off from an options perspective? And simple one, yes or no. And so far, at least, the yeses still running away with it. 71% with 3 hours to go saying yes, 29% saying no. Trey, I've asked everybody else this. I haven't had a chance to get your pulse on this. I'm curious. You guys over there at Fidelity, obviously seeing a lot of flow going up day in, day out. Obviously last year, a record year for the industry. And maybe our poll aside, what are your personal thoughts? Do you think we'll be able to pull it out as an industry and top that 5.1 billion contract level this year? Or is that just a bridge too far?
Yeah, I'm probably just a little bit skeptical here as well, right? Already starting behind. I tend to, like to have probabilities in my favor, so it means a lot of catching up to do. Certainly a little jump in the market to the downside, right, could change things quickly. But, I just think the way we started last year, the big rise in January, the strong sell-off in February, just put that too far ahead. So I'll probably lean a little bit more skeptical to the no side, at least at this point.
Yeah, it's kind of hard to argue with that. We are behind, but our audience clearly firmly in the optimistic camp. I hope you're right. I hope I am wrong. I hope we do see some volume. Of course, that volume is going to come. If it's going to come, it's going to come with some shocks to the system. So all of you out there who are saying we're going to do this again, make sure you bear that in mind as you're saying that. We're going to need another February and October type event like last year, if not a few other things like a lingering trade war, government shutdown, a few other things lingering in the mix to keep the vol alive and the volume churning. Having a tranquil time in the market and record volume usually doesn't go hand in hand. So remember that when you're out there voting for all this volume out there. Also going to start adding some new flavors to some of these segments. A lot of you guys out there use Fidelity to trade your options. If so, we want to hear from you guys. You guys are always hitting up the trading desk, asking questions and things like that. So if you are a Fidelity customer, you guys can get asked the normal way, but get on the old desk as well. And if they find some good questions, we're going to start filtering those through here onto the show to get some questions from you guys out there in the Fidelity universe. Going to kick things off here. This is our first Fidelity question, which is kind of fun. Trey, you kind of sent this one in because you guys get this a lot. It sounds like on your desk. As an options seller, is it better to close out of my options positions early or let them expire worthless? We've taken this position kind of collectively as a network, certainly on this show, I mean, a lot of us come from an old market maker background, so we had it drilled into our heads very early. Close all this crap out. Don't leave any of it open. If it's anywhere relevant, remotely has a chance of going in the money, then close it out. I know when I was on the floor, I used to be a nuisance to my brokers. I go up to them and say, hey, I got a 3-lot on this strike, 20 handles out of the money. What can I do? What can you do for me? And they would just look at me and just shake their heads in disgust. But we would go to that level of just closing out all that stuff. Because at the end of the day, there's not much value to you of having that around. It's just risk at that point, particularly on the short option side. A lot of our audience lives on the short side, and they like to play a little fast and loose. They like to play a little bit close to the fire with these positions, and they get burned. And we just saw it today on the odd block. That guy had a great call right going on, and all of a sudden he kept it open, and then the last day it gapped up. And so he may have taken it off for a decent level, but it could have been a lot better. So that's the way we lean. Trey, when people are calling you guys up on the desk, I'm guessing you guys probably lean the same way, but what is the typical answer you guys give when you get this question on the Fidelity strategy desk?
Yeah, we definitely do tend to lean the same way with that one here. And it's something that we have to occasionally remind clients of here as well. Here at Fidelity, we have a lot of traders that do like to sit on the sell side, and I think this is coming up recently. A lot of put sellers starting to think about some of their positions, in the upside move that we had. But absolutely, I always remind them, hey, that premium that you sold, remember, this is the most you ever stand to make on this trade. If you're, looking at an option with an ask of 5 cents, at this point, is it worth keeping the trade on for that additional $5? With the risk that you're taking on here at this point. So always just remind them of that, put it in that view, and most people are, kind of clicks, right? Or the light bulb turns off in their head. Hey, that's a great point. Let's close this out. Here in those scenarios, but definitely something that's been top of mind here lately. So wanted to bring it on and share it with everyone.
Since we're on this subject, let me ask you the question that we ask every broker who comes on this show, which is on this subject of closing things out. Does Fidelity offer reduced or free commissions for, let's say, the option decays down to a nickel? Or does it cost a commission to close that out, or is that a reduced or a free trade over there?
Under 10 cents or under, it's actually free. So, we want to do our part to encourage our clients not to, leave that position on if you can. So, we completely waive it. Well, 10 cents or under.
And let's not forget about the fact that not closing options, if you are a consistent covered writer, you actually lose money waiting for your option to expire rather than buy it back. And let me explain. So, options don't decay. Options decay exponentially, right? Everybody's seen that chart of that last 30 days, how it falls off a cliff, right? We all know that chart. That chart is just for at-the-money options. It is not for out-of-the-money options. Believe it or not, an option that is 10% of the money will lose more dollar value from day 60 to day 30 than it does from day 30 to day 0. So if you cover an option for a dime or 15 cents and then roll back and sell the next option out, you will probably be a net collector of more premium on that trade than if you let that final 10 cents expire and then go sell a call. So what I'm saying is, yes, you're buying the call back for, let's say, 10 cents, but the next call out might be $2. If you wait for that 10-cent option to expire, because the other option is the further out option is actually decaying at a faster rate, you might only collect $1.80 or $1.75. So would I rather pay 10 cents and collect $2, or pay nothing and collect $1.75? Right? And with Fidelity offering free coverage, free execution below 10 cents, this is what I would call the no-brainer of the options industry. So if you do nothing, if you ignore everything else I say, folks, which you shouldn't, but if you do, take heed on this. Take advantage of Fidelity being like, hey, cover your risk, and go out and collect yourself more premium. Fidelity's happier because you're making more money and you're covering your risk. You're happier because you're making more money, and it's kind of a no-brainer. So, folks, be smart, be effective, and think, and don't fall into that box of never closing.
Gotta get that last 3 cents.
Yes, people who never close never make money.
Yeah, I think that's a good way to put it. And yeah, it's good to see all the brokers. That's why we have to ask this of everybody now. We're trying to get everybody online. It seems like most of the industry is coming along to this notion of, we got to incentivize people to close these out, because there is this weird contingent of people out there who, if the commission costs more than the value of the option, they just won't close it out. They won't do it. It's just a psychological block with them. They can't do it. So it's good to see brokers out there incentivizing people to take this risk off the table. Let's see. We've got time for couple of quick ones here, quick chime-ins. Options Doctor, he's listening. He says he agrees. He says, close early after you have captured 80% of the initial credit received. Holding to expiration, usually not a good idea. Yeah, we agree with you. It's good to have some ballpark line. 80% is a lot. Some people go less, but if you get 80%, you're doing pretty good. Definitely take that bad boy off by that point, because again, why wait for that last nickel or 8 cents? It's going to wipe out whatever else at 25, 30, or 50 cents or a couple bucks you may have collected before that. So yes, definitely we agree with you, Options Doctor. And then we got Edip. Edip listening live. He says hi. Hi. Hello, Edip. Welcome. Hope you're enjoying the show. I love the little niceties that come in on the chat. They're always fun. All right, let's keep on rolling. It's time to go around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, time to go around the block here, see what we're watching for the rest of this week before we gather together again on Thursday. There are still some earnings on the docket. Most of the week's kind of quiet till you get to Thursday. Then we got some decent names. Uncle Mike's favorite, Dollar General. We've got Broadcom, Adobe, and Oracle all reporting on Thursday. So Thursday's still a decent earnings day out there. Again, if you're paying attention, look at theoptionsinsider.com. We got those great earnings move results reports coming at you, breaking down Costco, a bunch of others that popped off last week. Check them out. It's some good data. Let's go back around the horn. Let's start with Uncle Mike. Sir, what are you watching, keeping an eye on for the rest of this week until we gather again on Thursday?
Well, by all means, got to watch the 2,800 mark. Checking that out. Also watching to see what's going on with Boeing, to see how that affects the overall market. And at that stage, maybe I should announce my shopping orders at Dollar General, just to see, maybe give the audience a little bit of insider information on what the reports are going to be. But either that and Krispy Kreme, maybe. That could be it.
Spoiler alert, whatever you're shopping for, it's going to be $1. So just want to break that to you now.
I knew it.
That is a lie. That is a lie.
Well, now if you're going like Five Below, then it could be $5.
Yeah, no, but they'll be like, oh, it's a package of 10, so it's $10, but they're really $1 each. It's a big Dollar General. Less than half of what's in that store is $1.
Yeah, but in general, it's $1, hence the name Dollar General.
There you go.
Well,
see? Puns and
I
options.
think you have to be over 50% to. I think you need to be over a plurality does not mean in general.
Now we're gonna get someone writing in from Dollar General, full of umbrage. Our store is not 50% above $1. So I look forward to those angry emails. Direct them to Mr. Mark Sebastian.
Five Below that go to the high end place.
Yeah, I go to the premium $5 store. What can I say?
You're for Five Below.
Mr. Meatball, what do you got on the radar for the rest of the week, sir?
Well, Five Below aside, I'm just watching these S&P levels. I'm interested to see whether the VIX breaks its old low and whether VXX gets back below 30. There is a huge pressure on volatility. Apple today is making a huge breakout. It's now at its highest level since earnings. It's really rocketing higher. It is pulling things way higher. Breakup or not, who cares? Apple is highest level since the middle of November. So this looks like it might be making a run at that 200-day moving average around 190. So there is some strength there in Apple. So I think that maybe as Elizabeth Warren lobs more grenades, it'll be interesting to watch tech over the next couple of days.
Rallying in spite of repeated breakup threats, which is always interesting. Those 150 puts look like a distant memory now, right around 178, 179 today for Apple listeners. And last but not least, Trey, you've made it so far throughout most of the show. What are you keeping an eye on over there at the Fidelity Strategy desk this week?
Yeah, so as always, want to keep an eye on Brexit. So another supposed vote taking place tomorrow. It's just been such an interesting story to keep up with. But what happens with that? Do they manage to get a deal? Do they manage to delay? And how do the markets react? Also keeping an eye on economic data here as well. CPI report on Tuesday morning. Been a little boring the last couple of months, right? Month over month flat on the last couple of announcements. So, the consensus is, a slight rise at 0.2%. So just always interested to keep an eye on inflation or lack thereof. Is it another kind of dull one, or do we get a little bit of a surprise? We'll, wait and see tomorrow.
All right, everybody. That music means we've come to the end of another fun journey through the world of options. It's been fun mixing up the old all-star panel. Looking forward to more of that in the episodes to come. But before we go, let's go back around the horn, check in with everybody, see what they have working on, what they're working on that may interest you coming down the pike. Let's start with you, Mr. Meatball. If people want to learn more about these crazy things called options, maybe about when they should take these things off, where should they go? What should they do, sir?
Yeah, so we've just been announced as a partner with the Certified Financial Planners. If you are a CFP, you can get 12 continuing ed hours by signing up for our next class, Options for Investors, Money Managers, and RIAs. Go to optionpit.com/RIA Master and use code CFP300, and it'll take $300 off the price. So if you're a certified financial planner, 12 continuing ed hours on a course that you want to take. So kind of a no-brainer.
There you go, a no-brainer. Check it out, optionpit.com to learn more. And Uncle Mike, sir, if I want to go around clicking on foxes and having all sorts of fun, maybe doing call spreads with covered calls, where should I go? What should I do?
Come to my website at stcharleswealth.com. Would love to have a discussion with you on various strategies with which you can use in your long-term investing portfolio, and talk to you about how options actually have a very vital place there, assuming you match the right risk profile. Would love to have a conversation. Feel free to visit my website to learn more.
There you go. That's stcharleswealth.com to learn more. And last but certainly not least, Trey, you mentioned kind of all the cool stuff you guys have going on over there at the Trading Strategy Desk. If listeners want to check it out for themselves, maybe they want to reach out to you guys with some specific questions. When we're not doing shows here, they can hit you up all week long. Where should they go? What should they do, Trey?
Absolutely, yeah. Check out Fidelity.com. Go to our investment products and options. Just a great overview of all the option tools and resources that we have here at Fidelity. If you're a Fidelity customer, you have access to work with my group. Give us a call. Ask for the Trading Strategy Desk. Would love to have a conversation with you about your strategy, but we also host a number of online classroom sessions as well as online webinars. So great source for education for you also.
There you go. So you're not bereft in between shows. You can hit up Trey and the rest of the team. Tell them you heard them on the show. I'm sure they'll love that over there. Check them out at the Trading Strategy. Again, that's only for Fidelity clients. So if you're a Fidelity client, head on over there and check it out for yourself. And on behalf of myself and Mr. Meatball and Uncle Mike and Trey, who's nicknameless so far, we'll have to see how that unfolds in future shows. And indeed myself, I want to thank all of you for downloading, streaming, subscribing, for sending in such great questions, for listening live, all the fun stuff that you guys do. Keep them coming. And we'll see you back here on Thursday. Well, I'll see you back here in a couple hours if you're listening live, talking crypto, which will be fun. Crypto rundown. Otherwise, we'll see you back here on Thursday for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.